which try and explain the impact of capital structure on the value of the firm. So basically, it is examining what is the relevance of capital structure in valuation of an entity. Under that, we had started with the first approach, which was the net income approach. And this approach says that yes, capital structure is a very, very important decision for the firm because the overall valuation of the firm is dependent on the leverage which the firm is using. Okay, leverage means use of fixed cost funds, and as you increase the proportion of debt in your capital structure, it is reducing the overall cost of capital, and accordingly we calculate the we get the market valuation of the firm. Okay, so if the overall cost of capital is reduced, then the market valuation of the firm will improve. Okay, under this we had practiced a question also. So I'll just to recap the concept. I'll ask you people to come back to the question which we did yesterday on the net income approach. So this was the question that we practiced, and you people had correctly calculated what will be the impact on overall cost of capital if there is a variation in EBIT. Now, in continuation of this question, what I want you people to do right now is that instead of EBIT, we take this to be the new amount of debt in the capital structure. So with the information given, we now, that is EBIT 3 lakh, now we'll see what is the impact on overall cost of capital if the debt in the capital structure is increased to 8 lakh rupees, and the next case will be if the debt in the overall cost of overall capital structure is reduced to 2,50,000. Then how is the value of firm impacted, and what is the impact on the overall cost of capital. So I'll solve one part and then you can solve the other. So let us move with an 8 lakh debt in the capital structure. This step, the first step is that EBIT is the same, but now your debt is increasing from 5 lakh to 8 lakh, which means the interest in your capital structure, that is the interest to be paid, will move to 64,000. 64K I am writing, this space is less, so 64,000 will be the interest which will now be deducted from the EBIT, and you get your net income as 2,36,000. Okay. Now there are no taxes as per the assumptions in the NI approach. With a cost of equity as 10%, you get the value of equity as 23,60,000. The debt now is 8 lakh. So just make space. Actually, I'm short of space here, so you can write it properly in your copies. So 23,60,000, sorry, here is the amount of equity. You add the amount of debt and you get 28,60,000 to be the new value of firm. Okay. On this basis, now you can calculate the new cost of capital. So if using the same formula, I am writing this as KO dash. So 3 lakh by 28.6 lakh. Please let me know what is the amount coming to, what is the percentage coming to. How much is the cost of capital coming to? Sorry, I have added 5 lakh here. It will be 8 lakh. The new, this becomes 31.6 lakh. The new value is 31.6 lakh. Please make a correction here. I added the wrong value of debt there. So now your overall cost of capital becomes 9.49%. Okay. Yes. Thank you, Himanshu. So 9.49% will be the new cost of capital, and as you see, with an increase in the amount of debt in your capital structure from 5 lakh to 8 lakh, the overall cost of capital is falling from 9.67% to 9.49%. The second case is an opposite case where the amount of debt is falling from 5 lakh to 2 lakh 50,000. So there also please calculate what is your cost of capital coming to. This is 9.49%. Please calculate what is the cost of capital coming to when the debt is reduced from 5 lakh to 2 lakh 50,000. All these steps are there on your screen. Question is there, example 1. The only difference is that your debt is falling from 5 lakh to 2 lakh 50,000. The rate of interest is same 8%. So what happens when there is a reduction in debt? That is what you are seeing using this information. So it is coming to 9.83%, which means now your overall cost of capital is increasing. Yes. The rest of you also confirm you're getting the same value. Okay. So 9.83%. So what do we conclude from the net income approach? You increase your blank page. You increase debt in your capital structure. It is leading to an increase in the market valuation of the firm, which then leads to a fall. Okay, so increased debt is actually leading to a fall in cost of capital, which is then leading to an increase in the market value of the firm. This is how this whole cycle is operating. With increase in debt, the overall cost of capital falls and the market value of the firm improves. In the second case, you have seen that as debt falls, the overall cost of capital increases. With that, the market value of the firm falls. So this is what we deduce from the net income approach. Okay. So I hope this is clear to everyone. Now we move to the second approach, second theory under capital structure, which is the net operating income approach. And as I told you, the net income approach and the net operating income approach have a totally contrasting view, though they have been given by the same person, David Durant, but NI says yes, capital structure impacts the value of firm. NOI says no, capital structure does not impact the value of firm. Why? Because with an increase in debt in your capital structure, the risk of equity shareholders increase, and then with every additional percentage of financial leverage, they expect a higher return on their equity holding. Okay. Another justification which is given here is that the firm is calculating it is capitalizing the overall the EBIT which it is earning. Okay, that is the market value of the firm is dependent on operating income and the business risk. Value of the firm as per this approach is EBIT by KO. KO is your overall cost of capital, which NOI is saying remains the same. इसका मतलब वैल्यू ऑफ फर्म किस वेरिएबल से इम्पैक्ट हो रही है, EBIT से इम्पैक्ट हो रही है. Okay, the operating income of the firm, which is dependent on the risk which are faced by the firm. So KO remains constant and hence it is an irrelevant variable in the valuation of the firm. Moving ahead, what are the assumption or features? The overall capitalization rate remains the same. You calculate the value of firm as I told you, EBIT by KO. Then from the value of firm, you reduce the value of debt and you get the value of equity. What we are assuming is value of debt, which actually is the case also. The market value of debt does not change. Okay, only and only if you have say listed debentures and their value fluctuates in the market, that again is a very minimal fluctuation. But if that is the case, then the value of debt will change. Otherwise, this approach here is assuming that value of debt, the market value of debt remains the same. So as market value of debt is same, the cost of debt will also remain constant, and using this information we calculate the cost of equity, EBIT minus interest divided by the market value of equity. So E will give you the cost of equity. Overall cost of capital remains the same. With increased debt, if you increase the debt in your capital structure, the cost of equity will also increase. So whatever was gained through this financial leverage through use of debt is offset by the increased cost of equity. Hence, the overall cost of capital remains constant. So how do we show this graphically? Just draw here only. So now you take the degree of leverage on the x-axis. You take the cost of capital, cost of equity, and KD on the y-axis. Cost of debt. So what are you seeing? That with increased debt in your capital structure, the cost of equity is increasing, and hence the overall cost of capital remains the same. So whatever was gained by use of cheaper debt is offset by increased cost of equity, and hence the overall cost of capital remains the same. This is how the NOI approach explains the irrelevance of capital structure decisions. Now this is graphically, we'll take a question and see empirically how is this proven by the NOI approach. So the question is there on your screens. You are given EBIT of a firm is 2 lakh. The overall capitalization rate is 10%. Debentures 8%, 3 lakh debentures. What is the value of the firm and equity capitalization rate according to NOI approach if debt declines to 2 lakh and if the debt is raised to 4 lakh. So which means you have three cases. Case 1 will be when debt is 3 lakh rupees. Case 2 will be when debt is 2 lakh, and case 3 will be when debt is 4 lakh. So I'll solve for one case and then we'll see what is the impact in the succeeding two cases. So step 1 is to calculate the overall, you will be first calculating the value of equity and the value of firm. Overall capitalization rate is given. So EBIT is given to be 2 lakh rupees. KO is 10%. So value of the firm is EBIT by KO, which is 2 lakh by 0.10, which will give you 20 lakh. Value of debt is 3 lakh, which means the value of equity will be 17 lakh. After this, you calculate the cost of equity. Two approaches to calculate the cost of equity. One is EBIT minus interest upon E. And the second formula which you can use, this is OR K KO minus KD. KO, I'll write this on the next page because the space is not enough here. Okay, the next formula to calculate cost of equity is overall cost of capital minus cost of debt into D by E. So we can use both these formulas to calculate the cost of equity. In case 1, we use first this formula. So EBIT given to you is 2 lakh, debt का rate है 3 lakh, so which means 2 lakh minus 24,000 upon 17 lakh will give you the cost of equity. KE1 is cost of equity under case 1. So let's see what is the value coming to. 2 lakh 24,000 is the interest on debt. Cost of equity is coming to 10.35%. And if you use this formula, the alternate formula that is available, KO was 10%, KD was 8%, KD is 8. I'm making some mistake here. Just let me check. By that time, please start solving second and third part. I'll just check this formula. Am I making some mistake here because I'm not getting the same value? Debt by equity. Okay, interest plus K. So now we are getting 10.35% here also. So both the formulas are giving you the same cost of equity. Now you can check what is the value of firm and the cost of equity in second and third part so that we can draw a conclusion on the NOI approach. The rate of interest on debt is same in both the cases. 8% debt है. Just repeat the steps. The second part, with 2 lakh debt, how much is the value of firm coming to? Himanshu, you are giving me the cost of equity 10.22%. Yes, I'll just check. So value will remain the same because it is not impacted by the change in value of debt. Overall cost of capital is the same and 10.33. Nipun, you're giving the answer for third part or this is with 2 lakh? The answer is 10.22. Check, recheck. Okay. Rest of you
मैम थर्ड
also.
पार्ट का आंसर
थर्ड का है बेटा 10.5. Nakul, what is your answer? What answer are you getting? There's some network issue. 10.5, yes, correct. Others also check, are you getting the same answer 10.22 and 10.5? So what conclusion? Okay, so I hope everyone is able to solve this. What conclusion do you draw from the NOI approach? You see that with increase in debt, your cost of equity is increasing. Okay, so 10.35 से 10.5% हो गई इक्विटी जब आपके डेट की वैल्यू इंक्रीज हुई है with fall in debt the cost of equity is also falling. But irrespective of the value of debt, your overall cost of capital remains the same at 20 lakh. Because you're capitalizing the EBIT to calculate the value of firm. Okay, so this is what you conclude from the net operating income approach. Any doubt, any question in this?
नो मैम
Okay, so we move ahead and we come to the third approach. Very important because you generally, from this chapter, you generally have a question from this approach. Practical question in the paper. The Modigliani-Miller approach is again saying that capital structures are decisions are irrelevant. Okay. Now this approach is based on the name of the two people who have given this approach. It is Modigliani and Miller, and they have given a behavioral justification of the NOI approach. NOI approach is also drawing the same conclusion. But how does this actually happen in the capital market is what is explained under this approach. Now this approach again is saying the same thing. Market value of firm is not impacted by the degree of leverage used. Debt जितना भी आप use करो आपकी market value of the firm remains the same because with increase in debt the cost of equity also increases. Okay, there is nothing which is gained by the use of low cost debt because it is offset by the increase in cost of equity. But how does this actually happen? It happens through the arbitrage process. So behavioral justification is the arbitrage process. What is arbitrage? How do you define arbitrage? Anyone? What is arbitrage? None of you knows?
Ma'am, is it
Sorry, Karan, I didn't get you. Please repeat.
Ma'am, it's a method in the financial markets
Hmm.
wherein they buy the stocks and they sell it at the same time.
Buy the stocks and sell at the same time. Why will you do that? When you find a discrepancy in prices. So yes, Nipun, you're buying in one market, you're selling in another market for profits. That is only possible when you're buying at a cheaper rate and you're selling at a higher rate. Okay, तो होलसेल में परचेज करा, रिटेल प्राइस पे सेल कर दिया, that becomes an arbitrage profit. Okay, now in the financial markets, if I talk about arbitrage possibilities, then very rare possibility in a stock market. BSE NSE में आपको प्राइस डिस्क्रिपेंसी एटलीस्ट स्टॉक सेगमेंट में तो कम ही मिलेगी, रेयरेस्ट ऑफ रेयर चांस होगा. बट इन दी फॉरेक्स सेगमेंट, फॉरेक्स सेगमेंट इज फॉर फॉरेन एक्सचेंज करेंसी ट्रेडिंग, तो करेंसी मार्केट में आर्बिट्राज की पॉसिबिलिटीज होती हैं. ओके, एंड बट दे आर अगेन ओनली फॉर फ्रैक्शन ऑफ सेकेंड्स. So arbitrageurs are actually experts in identifying this discrepancy. Say dollar rate in India and dollar rate in Singapore. If you equalize, you check, you find a discrepancy in prices. Okay, तो दोनों मार्केट्स में अगर डिफरेंस है, आप एक जगह से लोअर रेट पे डॉलर बाय कर सकते हो, दूसरी जगह पे डॉलर को हायर रेट पे सेल कर सकते हो. So this becomes an arbitrage opportunity. But then again, everything is online now, screen based trading है, तो बहुत short period, एंड शॉर्ट बाय शॉर्ट आई मीन मिली सेकेंड्स के लिए ये अपॉर्चुनिटी होती है. ओनली दोस who are experts in the market, especially in reading those quotations, are actually able to take advantage. And if they are able to take advantage, it is a very good amount because the quantum in which you are trading is very high. Even if there is a 0.0025 paisa difference and you are say dealing in $1 lakh, then that gives a very healthy profit to the arbitrager. Okay, so arbitrage is the process of taking advantage of price discrepancies. आप चांदनी चौक से परचेज करो क्लॉथ और आप से कमला नगर में सेल करो, तो प्राइस डिफरेंस होगा. उस प्राइस डिफरेंस के थ्रू जो शॉपकीपर प्रॉफिट कमा रहा है, दैट इज द आर्बिट्राज प्रॉफिट इन सिंपल टर्म्स. फाइनेंशियल मार्केट्स में यू आर ट्रेडिंग इन स्टॉक, forex, commodity, if there are any price discrepancies, then arbitrageurs are able to identify them and they are able to make profits. Okay, so the approach is using the arbitrage process to explain the irrelevance in capital structure decisions. Okay, now the assumptions, again all the approaches are based on some assumptions. Assumptions under this approach, first and foremost assumption is that you have perfect capital markets. Again, this is something which is hypothetical in nature. If you have a look at the assumptions of perfect capital market, they actually don't exist. The first assumption is there are no taxes. Okay. After that, transaction cost is also nil. So no transaction cost, no cost in terms of brokerage, no cost in terms of the transaction. Basically, transaction cost is on buying and selling of securities. So there is an absence of transaction cost, absence of taxes. Then symmetry of information. Symmetry of information means everyone in the market has access to same quantum of information. Okay. So any trader, any broker, any investor, all of them know the same thing about a particular stock. Okay, that is again something which is not practical. Generally people who are say insiders to the company, uh, or people who are say privy to some insider information will have more quantum of knowledge about a particular stock as compared to the average investor in the market. Okay, next assumption again, uh, impractical kind of assumption is that the cost of borrowing is same for investors as well as companies. Okay, so corporates are also buying, taking loan at the same rate of interest as the retail borrowers or the individuals who are borrowing. So this is again an assumption which is not actually practically possible. Corporates get loan at a more competitive rate of interest. Okay. By competitive, do I mean higher rate of interest or lower rate of interest as compared to an individual? एक कंपनी बैंक के पास लोन लेने जा रही है और एक इंडिविजुअल बैंक के पास लोन लेने जा रहा है, किसको बेटर रेट ऑफ इंटरेस्ट मिलेगा, लोअर रेट ऑफ इंटरेस्ट पे लोन किसको मिलेगा? कंपनी और इंडिविजुअल? ऑब्वियसली दी कंपनी, यस करण एंड मार्वी, यू आर राइट, बस जो कंपनी का क्वांटम ऑफ लोन होगा वो ज्यादा होगा एज कंपेयर टू एन इंडिविजुअल. So institutional borrowers get a more competitive rate of interest as compared to retail borrowers. Okay. So, but here under this approach, we are assuming that the rate of interest for both the entities is the same. Then there is no flotation cost. Flotation cost is the cost of issuing a security in the financial market. So, no flotation cost again is something totally hypothetical in nature. No corporate dividend tax. Securities are infinitely divisible, which means, say, I'll just take an example. Say stocks are available in multiples of 100. So if you have to buy shares of Infosys, for example, you will either purchase 100 shares, then 200 or 1000, 10,000 and so on. You can purchase in multiples of 100. But approach says that you can get 111.55 shares also. Okay, or 195.25 shares. So infinitely divisible means that you can borrow in fractions, you can purchase securities in fractional amounts also. And last point is personal leverage and corporate leverage are perfect substitutes. As I told you, the cost of borrowing is same for investor and company. So whether you are in borrowing in your personal capacity or as a corporate, okay, as a representative of a corporate which is taking loan, you are getting the same rate of interest. Other three assumptions we have done: 100% dividend payout ratio. All investors have same expectation about EBIT. They are expecting the same level of EBIT from the company, and the business risk is the same. So on these basis, we will take up the behavioral justification. On Monday, we'll take up that. We'll stop here.